Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome to Traders Corner, the final show of 2014, and joining me this evening is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, last week, in last week's show, we talked about what could have gone horribly wrong for the portfolio. Luckily, it didn't. You made a gain of about 42%, so a great performance against the all-share index. But there were a few losing trades, and they could have been that much worse were it not for the stop losses. So note that you want to have a look at the 4 trades that could have been really catastrophic for you this year.
Yes, that's right. We're going to look at that and we're going to hone in on these trades. And I think it's always useful to learn from your mistakes or to look at which trades went wrong and why did they go wrong and what could have happened. The one thing is that we're always very, very disciplined about sticking to stop losses on this show. And I know that there are people out there, and I come across them all the time, they kind of ignore stop losses or move stop losses away or don't trade with stop losses even. And often with very, very disastrous consequences. And I just felt it very, very interesting when examining the trades that we did for this year's portfolio. We had 17 winning trades for the year. We had 7 losing trades. But of those 7 losing trades, there were 4 of them which, had we not stopped them out and had we just left them and sort of hoped that things might come right, as a lot of people like to do, it could have been absolutely disastrous for our portfolio. And so much so that, in fact, when you collectively take the potential losses for these 4 trades that we're going to talk about now, if we hadn't have stuck to our disciplines, it would have wiped out more than all the capital that we had in the account. So it just illustrates how important the stop loss is and why you've got to stick to stop losses in trading. It's vital that you manage the losses and manage your risk. So that's what we're talking about tonight.
Well, if anything, risk management might be in some ways more important than how the market is doing.
Correct.
Okay, so let's start off with the first one. It was a pairs trades. They haven't actually worked out very well for you, I think, in the 5 years we've been doing this show.
Yeah.
And it was the Resi against the Indy 25.
Yes, that's right. Our pairs trades have not been my sort of preferred strategy, I suppose, and we haven't done very well out of them. And this one we certainly didn't do well out of. Let's have a look at it. So this now is a graph which shows the relative strength of the resources index versus the industrial index. And the fact that it's been trending down illustrates that the resources are underperforming the industrial sector. But now, what did we see earlier this year? Well, first of all, we saw that this downtrend had been broken. And we noticed also that there was a very big, like a saucer-shaped base that had been forming on this relative chart. We also noticed that the relative had broken up above resistance and had pulled back and retested what we then saw as support of resources versus industrial. So at that time, this was now March of 2014, I looked at this setup and I said, well, you know what? It looks like now finally the resources are likely to start outperforming the industrials. And it wasn't just me that was thinking that. It was actually a fairly widely held view in the market at the time. You can see, obviously, that certainly did not happen. And the index, the relative continued to underperform. In other words, resources continued to underperform the industrials after that. If we just take a look at the next graph, this is a similar setup, but now this was the resources versus the financials index. And again, we were seeing something rather similar here. We saw a break of the longer term downtrend, a break of this more intermediate downtrend, and then a retest and pullback to support. And again, my thinking at this time was that now it looks as if the financials are likely to now start to outperform the resources. And once again, you can see that clearly was very, very wrong.
Underperform, you mean?
Yes.
Yeah.
Well, we were looking for financials to underperform and for resources to outperform. As it turned out, you can see from this graph that the resources continued to underperform the market. Anyway, the way we traded this thing was we did a pairs trade where we went long of 200,000 rands worth of the Satrix Resi, and we went short of 100,000 rand each in the Satrix Indy and the Satrix Fini, in order for me to play this strategy as I saw it at the time.
Yeah.
In the end, what happened was that we had to close out each leg of this trade. Only after about 3 weeks, we incurred a loss. My loss tolerance on this thing was about 6,000 rand. We ended up losing 7,364 rand on it in total. Okay, so not ideal. We lost 2.5% of our capital on that trade, but we walk away and we look for the next trade. Now, what might have happened had we not closed this trade? Let's just say that I didn't have that I couldn't accept the loss, and I just held on in hope that it would eventually come right, as lots of people like to do. Well, you can see
to this day, because now this is where you're taking these figures.
If I had still had this position on today, how would we be looking? And there you can see the losses are massive. So in total, the loss would be 83,000 Rand. In other words, 33% of our starting capital for this Traders Corner portfolio would have been wiped out on this trade had we not cut the loss at that time, executed the stop loss, and walked off. So this illustrates, now this is one of 4 examples, it just illustrates to you how important that stop loss was and how much potential loss it has actually saved us.
I mean, this is obviously kind of the maximum, so you're taking it, to this present point. You might have cut it out before, but the point is that it just continued to fall. There was no point at which it rallied and the trade would have worked out. So
no, exactly.
You would have lost more money no matter where you would have ended it after where you did.
Correct, that's it. So cutting this loss when we did certainly was the right thing to have done.
Okay, so what was the next disastrous trade? So AngloGold.
AngloGold.
You have not had fun with the gold shares
this year. The gold shares have not been good to me at all, and we actually traded this twice, and I'll show 2 examples of how this one didn't work for us. The first example was in May of this year. And what I'd identified at that stage was that AngloGold had been trending higher and it had been consolidating into a nice, well-formed falling wedge structure. It then started to break to the top side, and I looked at that as a buying opportunity to get long of AngloGold, thinking that it was likely to then move up and continue with that rising trend. And I must say, if I look at it back then, I still think it probably was the right thing to have done. But of course, it didn't work out for us. And my stop loss was a move below 179 Rand. We ended up getting out of that at 178 Rand. So we lost 6,700 Rand on it, which was 2% of our capital, not the end of the world, and you can see what's happened since then. Had we held on to this trade, and I know that there are people out there that get married to these gold shares, clearly it's been a disaster. And you can see if we still were holding that position now, we would be down 50,000 Rand, or 20% of our capital would have been wiped out if we didn't execute that stop loss when we did.
Gold shares, more than anything else, are the one-night stands of the market, that rather than marital partners. And I suppose there was a point there, July, when you thought, okay, no, this thing's turning around again. So, if you'd stayed in there, say, you hadn't stuck to your stop loss, you might have thought, okay, things are looking better again. I'm going to ride this one out, and of course, to your ultimate detriment.
Yeah, that's it.
Okay, so that was AngloGold. The next one was Sasol, wasn't it?
Sasol. Now, obviously, Sasol in the last few months has been a massive disappointment. But earlier this year, certainly up until about July of this year, Sasol was looking good. It was trending up. It was one of the strongest stocks in our market. It was by far and away the strongest resource stock in our market. And I saw this beautiful uptrend, which it held every time. We had this nice controlled consolidation through June and July, and then we saw the stock starting to break out to the top side through that consolidation. So I took that as an opportunity to buy. I went long of 360 CFDs at 627 Rand.
Which was in fact probably almost at the top of Sasol's share
very
price.
Much, it was very close. I think the high was about 640, but it was very close to the all-time high. Anyway, what you can see is that it breached our stop loss, and we were stopped out of that trade at 612 Rand. So we lost 6,100 Rand on this, which was 1.8% of our capital. So again, you're losing 1.8% of your capital. It's not the end of the world. You've still got 98.2% of your capital left in that situation. So it's not the end of the world. Remember, trading is not about getting every single trade right. That never happens. It's about getting as many of them right as you can, but it's also about managing those losses very, very carefully when they come along. Now let's have a look at what would have happened had we not executed that stop loss, and if we were still holding on to Sasol today, like I know many viewers probably are still, thinking that it's the bottom. And look where we would have been. We would have been down 77,000 Rand on that trade now, minus 31% of our capital, if we had just held on to Sasol in the hope that it was going to come right. And it so far has never come right.
And once again, it did sort of come right, because so you bought at 627 Rand. As you say, the high there, Trader France would probably call it a double top, classic double top that was set there. And you might have thought, okay, no, things are going okay. We're all right. I'm gonna hang in here. And once again, that was would have been very wrong thinking.
Yeah, that's it. I like to cut these losing trades quickly when they're going wrong, because even like you say, you can look and say, well, it did track along sideways and it moved a bit higher eventually after our stop loss was triggered. But what was that, 3 months later? And in 3 months, what's your opportunity cost? How many other trades have you potentially missed out on because you stuck in this trade? So that's why either a trade's working for me or it's not. And if it's not, it must go. And you execute the stop loss, walk away, and look for the next trade.
And the next trade, one of them, was AngloGold again, Garth.
Yeah. So yeah, as if I didn't learn my lesson the first time in March this year, I had another go at it back in July, August time. So what I saw at this stage now later, which was in August, I saw an inverted head and shoulders beginning to form here, and there was quite a nice little flag or channel type of structure over there, which was also forming the right shoulder of AngloGold. It was nice and oversold. I could have made a variety of arguments for why it looked imminent that this share price was about to break higher. And then based on that, I went long of 1,160 CFDs at 185 Rand a share. And unfortunately, once again, or not unfortunately, actually, fortunately, we were stopped out of this trade. And we were stopped out at 179 Rand when it started to breach those lows of August. And we lost 8,500 Rand on that trade, or 2.3% of our capital. What would have happened if we had just held on to this trade? Well, right now, as it stands today, we would be down 108,000 Rand on that trade, i.e. minus 43% of our capital, if we had have just held on to this AngloGold position. So, these are 4 examples of trades that we did for the portfolio this year. At the time, I thought each of them looked good, and I had my reasons for doing each trade. None of them worked out. We were stopped out on each of these trades, and we were disciplined. We stuck to the stop losses. We got out with minimal losses, and we moved on. But you can see how disastrous it would have been had we just held on to these trades and left them in the hope that it was going to come right. Hope is not a strategy when it comes to trading. Stop losses, I cannot stress how important they are, and this show illustrates that point very, very clearly.
The other point is that when you start losing oodles of money, you become your whole mental approach changes. You become desperate, and I guess you would start doing desperate things. And probably as a rookie trader, that's where you maybe cut your teeth, making really bad mistakes.
Yeah, look, every trader out there who's made a success of himself has at some point, done stupid things, and I include myself in that. I mean, I was a very slow learner. I made the same mistakes over and over many times. But you're right, any rookie trader will make these types of mistakes. And on this show, we try and preach proper trading principles in order to guide people in terms of the right way to do things, how to manage your risk, how to manage your position sizes, and so on. Hopefully so that the viewers don't have to go through the painful experiences that many of us have been through to learn these lessons.
Garth, just we've got a couple of minutes left. So 2014, I remember chatting at the beginning of the year, we thought maybe one would have to have quite a different trading strategy. That hasn't really been the case this year, has it?
Not so much, but we did do a couple of things different this year. And you'll recall right at the beginning of the year, I said that I thought 2014 might be quite a choppy year with a bit of volatility. And to a certain extent, that has been the case. We've been up, we've been down, we've been sideways for a fairly significant portion of time during the second quarter. And one of the things that I said at the beginning of the year we would look at as a potential strategy is look for those really extreme situations where stock gets hit very hard, look for a real oversold situation, look for a volume spike on specific events. And we did actually make a success of a couple of those kind of trades this year. The ones that I can think of off the top of my hand were First Rand in January after we saw an interest rate hike, Pinnacle when it got smashed in half with the director being arrested for alleged bribery. And then the last one was Steinhoff, which JD Group published a sort of slightly disappointing set of numbers, and that had a knock-on effect to Steinhoff. And what we identified in each of those trades were very, very oversold situations where the stock was likely to stage a bit of a recovery. And so that was one of the things I thought we would need to do differently in 2014, and we did execute that strategy quite successfully on 3 different occasions this year.
We have to leave it there, unfortunately, but we'll start 2015 maybe with a look at what we might have to do in the year ahead. Maybe it's going to be more shorting than going long. I think 2015 is going to be quite a tough year. But Garth, well done again. Fantastic year for you and the show. Thanks as always for joining us, and we'll see you in 2015.
Thanks.
That is Garth McKenzie, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.